The entire AI world seems to hinge on the fortunes of two names, Nvidia and Microsoft. Their chips, clouds, and clever code are everywhere, quietly dictating how far, how fast, and how lucrative this AI wave will be. But under all the victory laps, there's an odd tension flickering across the markets. Behind those eye-popping quarterly numbers and press releases, giant sums are being plowed into data centers, so large that power companies are eyeing record profits, and local grids quietly sweat. Think less Silicon Valley genius, more race to build the world's biggest electricity bill. Of course, nothing galvanizes Silicon Valley's top brass like fear of missing out. You'll find fundraising numbers from OpenAI and others that would have seemed mad only a couple of years ago, and you might catch Meta locking AI wizards into billion-dollar golden handcuffs just to keep them from wandering off to a rival. But if this all feels a tad breathless, you're not alone. Economist Thorsten Slock, for one, is sounding the alarm bells, saying today's market feels toppier than the dot-com days when the S&P top 10 felt untouchable until they weren't. Meanwhile, as the tech giants cheerily capitalize capex and tout profitable futures, others notice that some of the world's most powerful AI models, like China's DeepSeek, come at a fraction of the cost, though they only control a thin slice of global compute. There's a sense that the ground could shift suddenly and that even the biggest players might not see it coming. The ingredients are there for something fascinating. What if all this optimism is just a few hard truths away from becoming the stuff of business school legends? If nothing else, you're about to see how high the AI stakes can really go, and who might blink first. Nvidia and Microsoft have become synonymous with AI's promise and peril. Nvidia's GPUs power the massive machine learning workloads behind models like OpenAI's ChatGPT, while Microsoft integrates AI across Azure, Office, and GitHub Copilot, creating a seemingly unbeatable ecosystem. Their rise is no accident. Nvidia's share price more than doubled in 2024 alone, fueled by a data center market hungry for AI chips. Microsoft's Azure AI revenue shot past $75 billion annually, proving cloud infrastructure is the invisible backbone of AI adoption. This dominance means they've become the bellwethers. Investors view their performance as the proxy for the entire AI industry's health. But there's another side. When these giants sneeze, the market catches a cold. For example, a cautious note on Azure's margins in early 2025 led to immediate stock volatility. Traders are watching these AI titans like hawks. Their status lends a feeling of inevitability. If Nvidia and Microsoft stumble, could the AI boom unravel? They carry the hype and hopes for an AI-fueled revolution, making the stakes sky high, not just for them, but for markets betting the future on their continued ascent. Big tech's AI hype has a whiff of deja vu from previous tech manias. At face value, AI permeates everything from writing emails to coding, promising productivity gains unparalleled in decades. Microsoft's Copilot, for example, claims to reduce developer time by up to 40%, while Nvidia's chips enable breakthroughs in medical imaging and climate modeling. Yet skepticism lingers. How much of this growth is real innovation versus investors chasing the shiny new AI label? While OpenAI and others have raised eye-popping sums, many companies using AI admit they're still working out how to get real value from it. A recent Wall Street survey found over 60% of corporate execs admitted AI-driven productivity gains remain promising but not yet proven. Many startups boasting AI claims turn out to be repackaging legacy tech with a neural net label. The risk? Inflated expectations, pushing valuations beyond realistic business outcomes. Take, for instance, OpenAI's meteoric valuation leap. While impressive, the underlying cash flows remain opaque. Essentially, the big tech rally rides a mix of genuine breakthroughs and market mania. Some breakthroughs quite real, but some just clever packaging and exploiting AI's buzz. The question remains, are we witnessing a true fundamental shift or a pie in the sky baked by wishful thinking and investor FOMO? History has a habit of repeating, especially in tech bubbles. The late 1990s dot-com boom baked lofty valuations into startups with weak fundamentals. Investors are increasingly spotting warning signs in today's AI frenzy. For instance, Nvidia's price-to-earnings ratio eclipses even the peak dot-com levels, despite a market saturated with competitors. Meanwhile, Microsoft's rapid AI-driven revenue expansion masks growing expenses and regulatory scrutiny. The AI sector echoes early dot-com excess with speculative startups flooding the market, many promising moonshots, but struggling to show sustainable revenues. According to economist Torsten Slok of Apollo Global Management, the valuation of today's top 10 companies in the S&P 500, including Nvidia and Microsoft, is more inflated than the tech giants of the late 1990s. In fact, while many recall the dot-com crash as a cautionary tale, Slok warns that the current AI bubble might be bigger and more widespread. Meta alone reportedly spent over $1 billion in 2025 on retention bonuses and recruiting AI leaders, including industry stars like Alexander Wang from Scale AI. Startups such as OpenAI have raised billions, flooding the market with capital in a mad dash to build the next generation of AI systems. These wild salaries and funding rounds recall the fever pitch of 1999, creating a gold rush atmosphere. The market's narrowing focus on a handful of AI winners creates a fragile ecosystem vulnerable to sudden shifts. Regulatory pushback, such as the US and EU's emerging AI safety guidelines, could trigger abrupt resets, just as dot-com crash regulators crushed unsustainable business models. Parallels are striking. Soaring valuations, hype-fueled investment, and a nervous countdown clock. The question is whether history will again serve as a brutal lesson, or if AI's actual commercial promise can avert a full-scale collapse. Astronomical spending on building out new data centers is a defining theme. Meta's Hyperion project aims to deliver 5 gigawatts of compute power for its new AI lab, while OpenAI and Microsoft's joint Stargate data center may eventually require up to 5 gigawatts of electricity, rivaling the power consumption of small cities. Google is investing over $13 billion on data center expansions in the US alone, highlighting how critical infrastructure is becoming to the AI race. Embedding this compute power is vital because AI models demand billions of parameters and unfathomable levels of computation. For context, China's DeepSeek controls only a small fraction of the global compute power, but is aggressively trying to close that gap, demonstrating the strategic importance of compute itself in the AI arms race. The scale of current valuations is staggering and in many cases far outpaces earnings. Nvidia's market cap sits north of $4 trillion, despite chips for AI workloads making up a growing but still fraction of revenue. Microsoft, while more diversified, sports a PE ratio of about 35, high for a mature tech giant. Analysts highlight a troubling disconnect. Earnings growth is robust, but often insufficient to justify the sky-high multiples. To put it in perspective, in 1999, many tech stocks reached PE ratios exceeding 100. Today's AI leaders hover in the 40 to 70 range, with peaks in speculative microcaps far above that. Investors buy into the AI will change everything narrative, embedding decades worth of growth into current stock prices. This gamble extends to debt markets too, with corporate bonds issued under the premise that AI will drive future cash flows. A risky bet in uncertain times. Anecdotes from recent earnings calls underscore caution. Microsoft CFO recently remarked that while AI fuels growth, it also amplifies costs and operational complexity. The financial narrative is clear. The optimism baked into these valuations rests on big promises with real execution risks, and a stumble could trigger a swift and painful revaluation. If AI growth slows or proves less transformative than expected, the consequences could be severe. These companies' stock prices, rich with lofty expectations, could plunge, dragging down indices heavily weighted with tech. Consider Microsoft. Its reliance on Azure AI for its future growth leaves it vulnerable if enterprise adoption plateaus or pricing pressures mount. Nvidia's chip sales depend on continued demand for massive training workloads. If AI model scaling slows, their revenue could stall as well. Signs of this scenario already surfaced in mid-2025 when Amazon's AWS investment in AI infrastructure faced margin pressure, causing a 7% drop in share price. But that's not all. Regulatory scrutiny around AI safety and data privacy could delay product launches or increase compliance costs. Meta's superintelligence labs are attempting breakthroughs, but these efforts come with high capex and no guaranteed short-term returns. The risk is compounded by the competitive landscape. If startups and rivals develop more efficient or niche solutions, big tech may be exposed as slow or overly broad. Investors have begun debating scenarios ranging from modest slowdowns to a full AI winter, analogous to the late 80s AI hype crash. The key test ahead isn't whether AI works, it is whether the economics and regulation align to turn brilliance into sustainable profits. Behind closed doors, executives and major investors are cautiously managing their AI exposure, though it may not look like it if you read the headlines. Publicly, confidence abounds. Microsoft executives talk up AI as a multi-trillion-dollar opportunity, while Nvidia's leadership promises sustained growth. Privately, action tells a more nuanced story. Insider selling in Microsoft's stock ticked up modestly in mid-2025, coinciding with record high valuations. VCs, while still funding AI startups aggressively, increasingly insist on stringent milestones and exit options, reflecting anxiety about timing and scalability. Hedge funds use derivatives to hedge against tech corrections, some moving profits into defensive sectors. Anecdotes from recent conferences suggest a quiet diversification away from pure AI plays towards sustainable SaaS and cloud infrastructure providers. Company boards press management teams on, do we have a fallback if AI stalls? While the AI buzz dominates headlines, smart money respects the risks. Hedging is the middle ground between enthusiasm and prudence, acknowledging that while AI offers huge upside, the path is littered with uncertainties. So where are we headed? The tech market sits at a crossroads. AI promises to disrupt industries in ways once believed decades away. Simultaneously, valuations and hype mirror the exuberance that preceded tech crashes in the past. The reality will likely lie somewhere between extremes. Some companies, like Microsoft and Nvidia, benefit from entrenched positions and diversified portfolios, cushioning shocks. Others, especially speculative startups with aggressive valuations, face an uphill battle to prove lasting value. The cloud of regulatory uncertainty adds another layer of complexity. AI governance frameworks being developed could either smooth adoption or choke innovation. Meanwhile, competition, cost inflation, and geopolitical tensions may slow growth. Investors and observers must pass the hype from tangible results. This might be a classic case of growing pains, where turbulent correction phases are followed by sustainable expansion. Or it could evolve into a full-blown bubble burst with collateral damage beyond tech. Either way, the AI boom's next chapters promise high drama, sharp lessons, and a real test of whether this time tech's promises match its profits. Thanks for watching. If you enjoy hearing about stories in tech and you want to support the channel, the best thing you can do is to like and subscribe. See you for the next one.